Hello, my name is Lauren Templeton, and welcome to the V Summit 2022. My presentation today is called Investing the Templeton Way. I am an investment manager, author, and financial commentator, but probably best known as the great niece of the legendary investor, Sir John Templeton. So I started my career in investing at a very young age. Around the age of 6 or 7, I started selecting stocks. And by the time I was in my early 20s, I had launched a hedge fund and spent several years completing my training under John Templeton. What I plan to share with you today is the investing methods and philosophies of John Templeton, as well as some current thoughts on today's market. I like to begin all of my presentations with some quotes from John Templeton to set the mood, so to say. The first is, an investor who has all the answers doesn't even understand the questions. A major cause of higher prices is higher prices. But when the trend is reversed, then lower prices lead to still lower prices. To buy when others are despondently selling and to sell when others are avidly buying requires the greatest fortitude and pays the greatest ultimate rewards. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. If you want to have better performance than the crowd, you must do things differently from the crowd. I really like this quote and remind myself of it all the time. If you want a different outcome, you have to change your choices. So that's another way of thinking of it. People are always asking me where the outlook is good, but that is the wrong question. The right question is, where is the outlook most miserable? So our investment process at Templeton and Phillips Capital Management is focused on value. And we rely on John Templeton's approach towards bargain hunting, which is really led by quantitative reasoning. We try to uncover statistical bargains, and then we turn to valuation and fundamental analysis to measure intrinsic value of the firm. And we're typically doing this using a discounted cash flow model, yet not exclusively using discounted cash flow models. We believe that contrarian views are rational outcomes, and the most successful investments that I have made in my lifetime, and I would argue the same for John Templeton, occurred when we bought companies that were temporarily out of favor. So the only way a stock can become a bargain is from a lack of buyers. That can occur through neglect, so it can just be a neglected, unknown company, or through a crisis or market panic event. We believe that trouble is opportunity. In our experience, the best bargains do come when the entire market goes on sale. Although these moments can occur in particular companies, industries, or countries, when the entire market goes on sale, it really is the best time to buy. These are moments of maximum pessimism, as Sir John called them. And at these moments, even high-quality growth firms can be purchased at a bargain. So I keep a desk plate on my desk to remind me of this strategy. Trouble is opportunity. To remind me that even when things get very scary, and create some discomfort for even the most seasoned investors, it really is an opportunity to invest. I'm reminded of a story that John Templeton, one of his analysts actually told it to me. And on the day of the stock market crash in 1987, which was October 19th, Sir John got up from his desk around lunchtime to go exercise in the surf. He walked in the ocean for about an hour every day outside of his home, Lyford Key. And his analyst couldn't believe he was leaving. And when he returned, they ran up to him and they said, John, what, don't you know the market is crashing? And he said, sit down, boys. I have something to share with you. We're in a bear market, but the good news is it's almost over. Please have your recommendations, your purchase recommendations on my desk by this afternoon. And he is known for saying on that day, this is going to make our returns for years to come. So when the market goes on sale in these big market events, it really is a terrific opportunity. And what I'm trying to convince you of today is that should be your perspective. You should wait for these events when the entire market goes on sale, and or look for crisis events or panics in particular industries or countries. Those are all good opportunities to increase your investment returns for years to come. Two other quotes that I think are worthy of mentioning is search for bargains. You should try to buy that particular investment whose market price is lowest in relation to your estimate of true value. And then never adopt permanently any type of asset or selection method. Try to stay flexible, open-minded, and skeptical. Long-term top results are achieved only by changing from popular to unpopular the type of securities you favor and your selection methods. Now, I know later in the presentation, you may have some questions about the current environment that we're in and the prospects for inflation going forward. And I would encourage you all to go onto the internet and research a memo that Sir John wrote. I think he probably wrote it in 2005. I would have to go back and check my records. But just Google Financial Chaos Memo, Sir John Templeton. And you will read one of the most insightful memos that I have ever read in my life. John Templeton corresponded via writing. He would often send faxes. He did not email or talk on the phone, but I would often go into my office and find a fax that he had sent overnight. And one day I walked into my office and found the Financial Chaos Memo sitting on my fax machine. And that memo discusses the prospects for inflation and also his recommendations for the safekeeping of your assets during inflationary periods, which are in bargain stocks. So now let's flip to our investment process. If you're curious about how we do it in our office, we start, like many value investors, with an initial quantitative screening process. So we are typically using Bloomberg or other services, but there are so many ways to do this out there now. You could probably do it with just Yahoo Finance or through the V app. I believe I have played around with that enough, and they make it very easy for you to go in and look at the quantitative metrics on their system, select the ones that you want to focus on the most, and that will help you analyze securities and rank securities. But we start with a quantitative screening process, and we're trying to look at all investable companies in the world. And some of our initial valuation metrics are price to earnings, price to cash flow, dividend yields, free cash flow yields, PEG ratios, enterprise value to EBITDA, earnings yields, price to sales ratios, price to book ratios, and price to replacement value. This is nothing earth shattering. It's similar to most managers that I know, but after we do the quantitative process, we're really going to focus on the bottom decile of the market. So the cheapest decile of the market is where we'll focus. And we're running these screens every day, certainly every week. And what you find is that the same securities have a tendency to show up over and over again. A lot of times those are value traps, but you will start to recognize when something new pops up. And, that may pique our curiosity to dig a little further. And if we like what we see through that process, we will try to estimate the intrinsic value of the business. And like I said, typically to estimate intrinsic value, we are using a discounted cash flow model. Sometimes we use a dividend discount model. We also estimate PE ratios on a 5 and 10-year basis to try to determine what the intrinsic value of the business is. And what I love so much about value investing is that it is a discipline. Investing is very, very difficult for humans because of psychological reasons, right? There's a whole field of study based on behavioral finance and decision-making regarding money. But there's so many impediments to investing at moments of maximum pessimism that I think the more discipline you can put into your investment process, the better. It just keeps you on track. So once we have estimated the intrinsic value of a business, we are trying to purchase businesses that are trading at a 50% discount to our estimate of intrinsic value. So we have built in a pretty big margin of safety into our stock selection methodology. And that is because we, just like everybody else, are sometimes wrong, or we just may have the timing way off as well. So we like to have that margin of safety there, and we're typically using a discounted cash flow model. And then if we have found a company in the bottom decile, we've estimated the intrinsic value, we have found that there's a 50%, that the stock is trading at a 50% discount to the business's intrinsic value, we will then look to see if it has earned a place in our portfolio. And often that depends on how much cash we have, or if this is a better opportunity than something that is currently in the portfolio, which is something that I learned from John Templeton. He always said, don't sell a stock until you can find something that is at least 50% better. So that is a rule that we use. We also keep a wish list of securities in our office, which is a tool that I often talk about. I think I've talked about it with some B audiences before. But these are stocks that you have researched. Perhaps you ran a discounted cash flow model on them. You found that they were not attractively valued, but you felt the business model was very compelling and you would like to own the shares. They're just not currently priced right. That stock might go on a wish list. So why is a wish list important? Well, it's very important for psychological reasons, because in bouts of market pessimism or maximum pessimism, when everyone gets scared, even the most seasoned investors and all the financial commentators on TV or elsewhere are talking about selling stocks, you can then use trouble as opportunity and go into your desk drawer or your computer and pull out your wish list. And when you do that, there is a very calming effect, meaning you start focusing less on the money you've lost in the market and more on the opportunities that you're going to have to buy incredible businesses at deep discounts during these periods. And we really have found that the best investments we have ever made have come from purchases during these time periods. Of course, I'm well known for talking about the financial crisis, the great financial crisis. And my daughter was born on March 10th. The lows of the market were reached on March 9th. I can remember going on CNBC saying, my daughter's going to usher in the next big bull market. And people thought I was crazy. But what I can tell you is that stocks were incredibly cheap then, even though we had been buying them for a few months in advance of March 10th. But we were using our wish list and we were just putting capital to work every day. But some of those purchases were the greatest investments, maybe of our lives. We'll see if the next financial crisis is bigger, which I suspect it might be. And then we have different types of positions in our portfolio. So we refer to those positions as compounders or tactical discounts. So a compounder is a really well-run business that we want to own for a very long time. Tactical discounts are discounts that will probably close very quickly. So these are purchases that we've picked up during a market panic or a crisis event. We're happy to hold them, for a shorter period of time. But when the stock hits our estimate of intrinsic value, we start to sell the position. So that gives you some idea of our decision-making process. Now, we believe that investing is an incredibly competitive undertaking. You should know that. It is one of the most competitive industries in the world. You have very smart people working in the industry. Everybody has different opinions. You have computer algorithms you're trading against. So it's an incredibly competitive undertaking. And gaining an edge as an investor can be extremely difficult. We believe that there are 3 sources of alpha available to you. And this is where you need to do a bit of soul searching, because I do believe that, there are a lot of different investment strategies, and there are a lot of positive merits to many of them. And you really need to find which one is best suited to your personality. I think if you are not honest with yourself or your makeup, then you will not have investment success. So I think it's very important to know yourself and be honest with yourself about decision-making, what your personality type is like. But the 3 sources of alpha are better information, better process, and better behavior. So let me talk to you about better information. So you can try to get an edge over your competitors using better information. Obviously, investing has changed a lot over the years. I forget which year regulation full disclosure came out, but obviously when it did, it changed the information a lot, the industry a lot. It's very hard to have better information now. I mean, inside information is illegal to use. So better information, I know managers that go in and hire people to scrape websites and try to get, a competitive edge using better information to know what the numbers are going to be before the earnings release comes out based on scraping websites for data. You can build a better process. So those are really the quant managers. And I don't play in this space very well. So we're talking about managers that are constantly trying to build a better, faster algorithm. Or the last, which I think is the place where we focus and that works the best, is simply having better behavior. So while we do try to seek an edge in all 3, our clearest Our clearest edge as investors comes from a deep mastery of having better behavior. And this is where behavioral finance really picks up. We believe that our investment performance depends on our continued ability to make wise purchases when the most value is present in the market. And typically that is during these moments of maximum pessimism. So we're talking about panics, crisis events, recessions, and bear markets. Do you know the average person spends about 1/3 of their life in a bear market? So you might as well get used to it and learn how to harness the power of the bear to improve your returns. If you can learn how to do that and not panic, use your wish list, let the market work for you by putting capital to work when it's actually feels the most risky, but it's actually the least risky, then I have no doubt that you can outperform the indices and your peers if you can learn how to do that. But you do have to train yourself because humans are not hardwired to become or to be good investors. It's just not natural. So I always use this slide in my presentation. What is Homo economicus? I don't know if you've heard this term or not, but it is a term that academics use to describe man as a perfectly rational wealth maximizer. So how many of you out there believe that man is a perfectly rational wealth maximizer? We're virtual. I can't see you. This is even pre-recorded, I think. But I'm guessing that none of you are going to tell me that you think human beings are perfectly rational wealth maximizers. I mean, human beings really aren't very rational at all, and particularly when it comes to making financial decisions. But despite the fact that most people acknowledge that humans aren't rational, that Homo economicus doesn't exist, Homo economicus is the basis for many of the theories developed in business school, developed and taught in business schools around the world. So whether that's capital asset pricing model, arbitrage pricing theory, all of those rely on the existence of Homo economicus. But you know that Homo economicus doesn't exist, that humans are very irrational, particularly when it comes to money. And you should use that to your advantage. So here is a slide. It's produced by Dalbar. And Dalbar actually produces a couple of great charts every year. But what I want you to know is this shows the average equity fund investor return versus the S&P 500. And the average equity fund investor underperforms the S&P 500 over a 12-month, 3-year, 5-year, 10-year, 20-year, 30-year time frame. But Dalbar also produces this chart, and it shows the average investor versus all of the different asset classes. So real estate, equity, fixed income, and you find the same pattern. So it doesn't matter what asset class we're talking about. The average investor over both the short and the long term underperforms the market. So that is really just crazy when you think about it, particularly when we consider the fact that these days over half the market is passive. So you have over half the market invested in passive investment strategies. So the fact that this relationship still holds and the average investor underperforms the market shows you just really how tremendously bad humans are at making decisions. So why does this happen? Well, it's human instinct for the market to go up. Everybody gets really excited. Woohoo, crypto's hitting 60,000. I must invest in crypto, or whatever. You want to invest in what's most popular, what's had the recent best performance, but that's actually going to probably produce the worst results. So you have to train yourself to think a bit differently. And you can do that. I've trained myself over the years. It is not natural, but once you learn to do it and you put capital at risk and you deploy capital during these moments of maximum pessimism, whether it being a total market sell-off or in an industry or a company or a country, and you reap the returns from those purchases made at those moments, then your brain will start to rewire itself, and it becomes less difficult. Here in this office, we get quite excited during market sell-offs because we know that is our opportunity to compound capital at a higher rate of return than our competitors and to make extra money for our investors. So you're going to spend about 1/3 of your life in a bear market. Get used to it. They're coming. They're a staple to the market. Harness the power of the bear to your advantage. I have no doubt that you can all do this. Crisis events are a staple to the market. They will continue to occur. I forget the actual data on this, but they are very common. And here are just a few that have happened during Sir John's lifetime, although he passed away, I think, in 2008. So we added a few at the end. But crisis events are staples to the market, and they're going to occur with some frequency. And these are golden tickets for you guys to improve your investment returns. In fact, I have a new podcast coming out. I hope you will all watch it. It's called Zinvesting. And I just filmed my first interview this week with the legendary investor, Jim Rogers. And oddly enough, his birthday is on October 19th, which is the day of the market crash in 87. And I asked him about that. I said, do you have any stories you can relay from the 87 crash? It was on your birthday. And he said, it was my best birthday ever. So I think that's how very accomplished investors view the market as a mechanism. And the volatility in share prices, that is your friend. So I think Schiller originally produced the research that showed that stock prices are actually 14 times more volatile than the underlying businesses. And that is a huge gift to you. So based on your perspective as an investor, that can be 14 times more the antacid you're going to eat every year because you're so upset and you don't like the market volatility, or 14 times more the opportunity that you have to compound your returns at a higher rate than the next guy because you take advantage of these, you take advantage of market volatility. So valuations still matter. So here's some thoughts on the current market. I do think markets are high. There's clearly a bubble in the bond market. Property values are very high. Although the U.S. listings are quite bifurcated, you've had some stocks that are clearly in bubble territory. You have others that haven't performed. We still are, on average, overvalued. So the current estimated PE on the S&P 500, I looked this up right before the call started, it's actually 22.8 times versus a historical average of 17.9 times. So overvalued. So what does this matter to you? Should you stay out of the market? Sir John always said that you should invest when you have the money. Why did he say that? Because he thought as human beings, you would rationalize spending it. If you leave it sitting in a checking account, you would find a way to rationalize spending the money. And that it's best not to try to time the market. No one's very good at doing it. I have yet to meet anybody that is a great market timer. That doesn't mean they're not out there. Maybe they are. But I don't know them. And so because of that and the market being overvalued, in our opinion, although there are pockets of undervaluation in places, and clearly emerging markets are trading at lower valuation levels than developed or the U.S. markets. But on the whole, markets are pricey right now. So why does this matter? Well, it matters what you buy. And so this is really where you can earn your stripes as a value investor. It is always going to matter what you pay for an asset. It matters what you pay. Valuations still matter, and they will continue to matter. You know, value has underperformed growth for some time, but I'm telling you, value still matters. So today, as we speak, in the U.S. markets, there are actually 701 companies trading at a price-to-sales ratio greater than 20 times. That is a remarkable number. Greater than 20 times. I believe that, you know, I think the number's like maybe 16 or maybe 18%. I think it's 16% of the Russell 3000 is trading at a price to sales ratio of over 10 times. I would want to go back and check that. But for sure, there's 701 companies in U.S. markets trading at a price to sales ratio of over 20 times. It's remarkable. So let me give you some perspective on that. And this is something, a quote that I just love. It may be one of my favorite quotes that ever came out. And it was given by a CEO named Scott McNealy. And it's from an interview with Bloomberg. And he's talking about his company after the dot-com crisis. So his company had traded at a price to sales ratio, a very high price to sales ratio. And he's telling investors after the company had declined in value, some perspective on that. So Scott McNealy said, at 10 times revenue, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. That assumes that I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard with 39,000 employees. That assumes I pay no taxes, which is really hard. That assumes you pay no taxes on your dividends, which is kind of illegal. And that assumes with zero research and development for 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at 10 times sales? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need any footnotes. What were you thinking? So I just love that quote because it really emphasizes, the common sense of value investing. It does matter what you pay for an asset. And the fact that there are 701 companies trading on U.S. exchanges with a price to sales ratio of over 20 times, I mean, alarms should be going off for you. So let's talk about the similarities between today's market and the dot-com bubble, because I do think there are some similarities. I graduated from college in 1998. So that was the first big bubble that I saw. And I can recall, hopping on a flight and going down to Lyford Key and visiting with my uncle. We were having lunch by the pool at Lyford Key, and I made the dumbest mistake ever. I asked him, so what tech stocks are you buying? And he was so polite, but he shook his head and he said, well, I'm actually shorting tech. I am using an IPO lockup strategy. I short companies about 7 days prior to IPO lockup expiration and cover about a week later. But then he took the opportunity to tell me about another bubble that he had experienced in his lifetime, and that was electricity. So he told me as a child that he and his brother would walk to town and stand outside of a home located off the town square in Winchester, Tennessee, and that many people would gather there, and the homeowner would eventually come out, flip on the lights, everybody would, cheer. It was the spread of electricity, and it was going to change the world. And guess what? It did change the world. But he had researched electricity stocks, and he found that the time to get out of those stocks was much prior to that event. I had a similar conversation with Jim Rogers this week. We talked about bubbles and radios, electricity, television, computers in the 1960s. And then, of course, the dot-com bubble, where if you put .com behind the name of any company, you got a high multiple in the marketplace. And of course, the later implosion of the dot-com bubble. And there's some really incredible stories from that collapse that are entertaining to read. And I suggest that you all go research them. They are incredibly entertaining. But I'm not going to talk to you about any of those flops. I want to talk to you about a dot-com success story, which is none other than Microsoft. So Microsoft, it was an incredible success story coming out of the dot-com crisis. Microsoft was launched in 1985, and it has maintained its desktop software prowess ever since, with a formidable 77% market share. From a 1990s tech bull perspective, Microsoft has been living the dream. And the company still dominates the market it created decades ago, as evidenced by its over 1 billion users today. Far from a one-trick pony, in the last 20 years, Microsoft has successfully tackled the gaming market, and not to mention it has fought off Google during its transition to cloud-based desktop with Office 365. It has been an incredible success story. But despite its myriad successes during the past 30 years or so, investors that bought shares at the height of the dot-com mania in the late 1990s had to wait 17 years to generate a profit. So if you had bought Microsoft in 1999, you had to wait till 2016 to generate a profit. It's just incredible. In hindsight, it's relatively easy to see that back then, Microsoft's price to sales ratio of 21.9 times and its PE of 61 times had already accounted for almost 2 decades of success that would follow. In 2022, we count no less than 701 stocks in the US trading at more than 20 times sales. What are the chances that any of those companies are going to be at least as successful as Microsoft? So it does matter what you pay for an asset. I know that you are all very familiar with value investing and all of the resources that V has to offer. But you need to use those, because right now it does matter what you pay for an asset, and it's getting harder to purchase an asset at a reasonable valuation. So it's a good time to be careful. Markets can stay irrational a lot longer than anybody anticipates. I have no idea what the market's going to do today, tomorrow, next month, or even next year. But I would encourage you to be diligent and use the V app if needed to identify attractive purchase prices for securities. And I believe here's my contact information. You can follow me on Twitter, visit my website. We have a free newsletter called the Maximum Pessimism Report. We don't put it out very often. It's free. And here is my other credentials, I'm happy to connect with any of you. So with that being said, that is the conclusion of my presentation. And thank you so much.
Thank you, Ms. Templeton. So glad to have you here with us again. And Happy New Year to you.
Happy New Year.
New Year is so great to meet again because I believe our graduates have they need timely reminder. I always tell them these are not new, but these are always what I would say, you can say seasoned value investors or the gurus, the experts will always remind us regarding this word called behavior. Yeah, as much as we are looking at the numbers, we are looking at the hype of technology stocks or the share prices going up and high, and we are so eager to really get them. But behavior is really something that we need to focus on. And that's a really timely reminder, especially right now, looking at the stock market. So there is some form of correction. So I would like to ask Ms. Templeton is this, because I love the quote, trouble is opportunity. So my question is this, are we in trouble now?
Well, who knows, Pauline, really. I mean, we're looking at a bubble in the bond market. We're looking at extended valuations in the equity markets. Who knows what the market will do? But it is important for all of your listeners to understand that harnessing the power of a sell-off, a crisis, a market panic will help them distinguish their returns. So I'm hoping we have a big sell-off in the equity markets. I mean, we've had a bit of a correction lately, and I hope we have even more because that is a greater opportunity for me to compound returns at a better rate in the future.
Yeah, that is what our CEO always say, Mr. Kenshi. Let's pray hard that there is a market crash. And that is always something that we love to say, which all graduates and our community in view is like, why are we always praying for crash? But this is what the value investors, I believe we always say, well, because this is where the opportunities are, because nobody would want to buy when it is high, right? That seems to be a very commonsensical stuff, but what is common sense is normally not a common practice by so many people, right?
You're right, Pauline. Common sense is not very common.
Yeah.
And it's much easier to invest when markets have sold off. Like I said, I'm not going to discourage somebody from putting capital to work today because I do think there's a lot of wisdom behind Sir John's advice to invest when you have capital. But it's a lot harder today. So my job gets tremendously easier when the market sells off. It's just it's easier to put capital to work today. Takes a lot of research. You have to be very, very careful with what you buy to make sure that you're not overpaying. There just are not as many opportunities available to investors today.
Yes, especially retail investors, where the funds may be quite limited in terms of your paycheck. And this is all the more that we really have to practice. I believe just now, Ms. Templeton has said this word, discipline in all our investing. And we have to do our due diligence. So that puts me to the next question, because you showed a really good slide to say that 1/3 of our lives actually are in the bear market. And I started investing I didn't have an uncle to teach me about investing, right? Like you started at 6 to 7 years old. How I wish I could have done that. I started investing only in 2010 when I get to know about V College. And since then, there is the Euro debt crisis that I started with, which the moment I learn about investing, I see my portfolio drop like 30%. And yes, I must say, as a new investor, that was really scary because I thought the subprime credit crisis was over. The market seems to be picking up. Just as the market picks up, I started my investing journey and I see all the, I would say, news coming along to say that Greece is having problems. the PIIGS, all the companies, all the countries in Europe are having issues, and people are thinking that the next subprime credit crisis is coming again. So the thing is this, it actually lasted for quite some time, and then there are a few years of good years for us, as we see in terms of the stock market. Then it comes to 2018, where you mentioned the Christmas flash crash. Oh, this is the first time I heard about Christmas flash crash. I mean, I was on holiday during that time, 2018, and I bought Adobe during that period of time, and it makes me very good return. Yeah, but I didn't know it's called the Christmas flash crash. This is the
Pauline, we were also out of town. I always tell people, if you want to predict the market very well, you need to get a copy of my vacation schedule, because if I'm on vacation, the market is going to go down a lot.
Right. So next time when Miss Templeton is going on vacation, or maybe if she's having her third child, let us know.
Yes, yes, I know. Well, I don't think I'll be having a third child, but if I did, that would be the time to buy for sure.
Oh, yes, right. So that was the next question, because many of our investors, especially new investors, we had a wake-up call in 2020 when the COVID struck, and many of our investors actually get to know, because today we have this term called the game changer. This COVID have really changed a lot of things in our lives over the past 2 years. And things that we thought have been going on very well, all of a sudden went, just vanished, or it couldn't work. For example, let's take a look, like, even stocks like booking.com. Well, seems to be doing very well because everybody's going on holiday. All of a sudden, it just stopped. This is something that we couldn't foresee. And after 2 years, we still have not seen it. I mean, it's slowly coming back, but we are still getting a very precautionary measures in terms of traveling, in terms of getting the normal way. In fact, like in Singapore, our government is saying in terms of the new norm that we are going into it. So let's say if I'm a new investor, I just started investing and I miss the 2020 crisis, which was really good, but it was too short.
It was very short, a few days.
Yes, it was just like a week. And I was like slowly buying, thinking that it will last for some time. All of a sudden, by May, all the stock prices just seems to go back up as per normal. Like the COVID has never happened.
Yes, I really think a lot of that is algorithm driven. Like these moments are so condensed now. In the past, when you study the crisis events, you could start buying and you could really, space out your trading activity. But now, because of the algorithms, I do think the market reacts a lot quicker. Yes. And so your wish list is even more important. You need to have done the research in advance so you can go when the market sells off.
Like for me, even after 10 years, I only activated like 10-20% of my funds before I know that the market just gone right now. Yeah, it's gone. My opportunity is gone. And trouble is opportunity. Oh my God, why is the trouble still here, but the opportunity is gone? That was what I was thinking during that time. So the question for the new investors, they are always asking, do I wait for the next one to come? Or should I, like what you mentioned, if I have some money, I have some capital, I should put it to work for me. What is your take on that, for especially the new investors?
Well, I think you have to be careful giving investment advice. I am often wrong. So know that if you follow my advice, you could certainly be wrong. I am wrong plenty of the time. Having given this a lot of thought and considering Sir John's wisdom, which is investing at the time you have the money, I do think it's wise to go ahead and invest in the market. Now, depending on your appetite for risk, you might try dollar cost averaging. You might invest a little bit every month and not put the whole amount to work right away. So that is something that we have worked with investors who are a little bit more risk averse or that are older and they're coming in with capital and they really can't afford to take a really big hit on their investment portfolio. We'll say, okay, let's dollar cost average in. We don't really know what the market's going to do, but if you invest a little bit every month, that seems to be a very reasonable approach to investing.
Yes. And I totally agree with Ms. Lauren Templeton. And that's the reason why you see, we have been doing that. That's why we missed the opportunity, probably because we actually space out a bit of like 5%. another 1%, another 10%, and we slowly do it dollar cost averaging, especially when we find companies with great fundamentals. And of course, when it has a better discount, like what Ms. Templeton has said, higher margin of safety. We always love discount. The more, the merrier. And that puts into the next question of, we love to have margin of safety, but how do we differentiate a margin of safety from this thing called the value trap? Right, that we like discount, but certain companies, how do I know that if I continue to do a dollar cost average, it's not a value trap? Yeah.
Well, you have to know the company for sure. So a loser in your portfolio can be defined in absolute terms, like you've absolutely lost money on the position, or relative terms, you may be able to find a company that is a better opportunity. We would, if the stock was declining, we would do analysis. We would go back and review our research, and we would look to see if any problems had surfaced. So problems to look for would be declines in sales growth or declining margins. Also, a loser may surface through poor management, including investment decisions. Firms that invest too heavily in bad investments or neglect reinvesting in their businesses might be losers in your portfolio. So if you have a stock that is declining in value, it's really important to go in and do the analysis and see if there is a flaw in your initial analysis, to see if anything's changed with the business. What is going on with sales? What is going on with their margins? So those would all be indications of a value trap.
Yeah, that's really, let me summarize really. Sales, take a look at the fundamentals. Yeah, the margins, their profit margins. And are they still having, I know Warren Buffett loves to say this, whether are they having a moat, right? Is the
right. Competitive moat.
Yes, the moat is really important. If they are losing the moat, please, you have to sell off. You have to sell off because businesses have changed. As we have said, the game changes. Some businesses, used to be doing very well, like Kodak. But because things have changed, right? If they have not changed their business model, you see, this is the reason why they would go downhill. So that also would put into the next context of, we know lately there are a lot of China stocks that are listed in the US stock exchanges. And it used to be they are the darlings. Why? Because China is a big market, and many of the companies like Alibaba, like JD.com or even Tencent, their fundamentals are sound. They have been increasing on their sales and revenue and profits. So the key thing is this, because of government interventions and probably about the policies, right? It seems like their share prices has been going downhill. In fact, as much as about 50 to 60% down. So some of our graduates are probably like doing dollar cost averaging, and even Charlie Munger lately have been buying more, while some investors are probably staying away from the China market. So maybe we could ask about the Templeton funds, or maybe Miss Lauren Templeton. So what is your take on the China market, or probably the China stocks that are listed in the US market? Yes.
Yeah. So, obviously, we do have a little bit of concern of the regulatory environment in China, but there is more of an opportunity there today than there has been in the past. And China is very well positioned to be, it's the second largest economy in the world. It's very well positioned to be one of the leaders coming out of 2021, 2022. And so we have a lot of interest in Chinese investments. We do not have any holdings currently. We did at one point own Alibaba, and we did sell Alibaba. So, but I do think it's a fertile hunting ground for your investors, and that it has not participated in the rebound because of the sell-off due to regulatory issues. I think it should be one of your first stops for investors to look for opportunities.
Yeah, yes. So I would say nobody knows the answer, not even Charlie Munger. But I do believe the principle still stays the same, as in make sure it's within your portfolio. Even if we want to do dollar cost averaging, even if you think that in future, all right, this company would do well, and you think that the trouble right now is an opportunity. Well, I believe, like any of the investors out there, every time if we want to take certain risks that we know, portfolio management is really important. Make sure it is within a comfortable range, all right, that we keep it such that we make the worst case scenario that probably this may not turn out that well as well, like what Ms. Lawrence would have said. Sometimes we do make mistakes, right? But just keep it in terms of what we can, afford to do with that. Yeah. So guys, always remember. So this puts also then to the next part, because Ms. Lawrence Templeton, every time I hear your speech, I have distinction. And this is, I think, the third or fourth time that I'm hearing your speech, even the Templeton way. Even though it seems like the same speech, but every time I get something out of it. And today, I heard about this thing, the differences between your discount compounder versus tactical. And that is really a very wise thing to do. Yeah, that certain stocks really, we can actually do it for the long term. And certain stocks, probably we take a look at, it closes very quickly and the market would have a panic and we buy into it. And sometimes it gets overvalued. We probably think there's a good chance of selling it. So not sure if Ms. Lauren Templeton can share with us one or two cases where, maybe one that you think is a compounder and one that you think is a tactical under your strategy. Yeah.
Yeah. So I'll give you a few instances of that. So compounders are really well-run businesses that do a good job of compounding capital over the long run. And we want to own them for a very long time. Yeah. Typically, these are companies that have a history of growing dividends, and we think they want to stay in the portfolio. And they're very hard to buy at a discount because they're quality companies. So we will typically pick those up in a total market sell-off, and we will not plan to sell them at any time in the future if their business model doesn't change. A tactical discount would be something like that we deployed on the one that just pops to mind, which is kind of old, but we deployed it in 2009, would be our purchase of Mexican airport operators on the heels of the swine flu crisis. So that was a good example where this swine flu crisis was going on. I mean, it was, over 10 years ago, and swine flu crisis compared to COVID. It's so hard to think back on all of that. But it was a panic in the market. People were wearing masks on the airlines, afraid to travel, all of that. And in the office, we were researching where are the opportunities. And we found those opportunities in Mexican airport operators. We didn't have a lot of time to do fundamental analysis on all of those businesses. So we bought a basket of Mexican airport operators. We deployed capital very quickly. We later consolidated the positions into one stock, and we held that for a few years and sold it, and we had generated a nice profit. But that would be a good example of a tactical discount. Another thing that you can think of is we purchased in 2020 PayPal. And we held that for some time. And PayPal is a great business, but we bought that on the basis of free cash flow yield. And we no longer saw the opportunity there, we sold that position. So that would be a good example of a tactical discount as well.
All right. Thank you so much. It actually let us also, I recall back the compounder that Warren Buffett owned Coca-Cola, and he really waited 13 years. Yeah, until there was a really big sell-off due to, I think that time was a new Coke coming along and it didn't do really very well, but they're changing and things like that. But that was a real good opportunity, and he waited for 13 years, and until now, Mr. Buffett is still holding on to it. So it's a once in a rare maybe chance to really sometimes hold great compounders and really have your wish list. Yeah. And yes.
Well, you have to remember that Charlie Munger, Warren Buffett, John Templeton, sometimes they held stocks for decades. Okay. So I think one of the things that we had discussed leading up to this call is whether or not you should try to emulate these investors by copying their portfolios. And, you can do that by looking at 13F filings, and there are even websites that profile the holdings for you. And it is a reasonable strategy. It's better for you to do your own research and make your own decisions. But if you're not going to do that, I think emulating these investors is reasonable, but you have to remember that they can have really long time horizons. And so you need to consider that as a factor. If you're not willing to hold a business for a decade, then you might not want to follow some of these guys on their investment strategies, because they did. Warren Buffett, Charlie Munger, John Templeton would hold a business for decades or more.
So that's why, guys, when we have a wish list, maybe you got to group them into, are these the compounders, or are you going to use the tactical strategy? That means you're going to put them in the wish list, but if there's opportunity as a tactical, the opportunity is there, you just grab it. And sometimes you might have to sell it off. I think one of a very good example was one of these stocks. I think during the start of the COVID situation, the duty-free shop in China were actually affected because temporarily the airports were closed down. So when Miss Lauren Templeton was talking about the swine flu about the Mexican airport, it reminded me of the China side. At the point of time when they have to close. But after that, when it starts to open up after a few months and people start traveling, you can see that, the share prices, the business, they just started to pick up. And of course, the share price reflects accordingly. Yeah. So that is just like a short period of that tactical. Yeah.
Yeah. And, Sir John used that too. That's just not us. So there were compounders that remained in his portfolio for a very long time. But then he also, I'm thinking, on September 11th, which is such a sad tragedy here in the United States, but also around the world, when they shut down the exchanges, he sent me a fax, and I think we've written the facts out in my book, Investing the Templeton Way, but it says, Lauren, when the markets open up, airline stocks are going to fall. I need you to research for me right now before the markets open up, which are the safest airline stocks. Who has the best balance sheets? And then I want you to buy any of those stocks that fall more than, I think it was 30 or 40% when the exchanges open up. And we did do that. And we were able to make a few purchases for him. And he held them for a while, generated a large profit, and then sold them. That's a good example of a tactical discount. So this was not a compounder that he was going to keep in his portfolio for a decade. But he was being very tactical in his deployment of capital. And I do think, these market crisis events and panics, bouts of maximum pessimism give you the opportunity to do both. I mean, really a well-run company doesn't go on sale very much. So it is an opportunity. Your first stop should be the compounders, right? So why would you even worry with the tactical discounts if you can pick up compounders in those moments? Because they can remain in your portfolio for a long time, reduce your workload. You could just leave them there. But then sometimes the tactical discounts are so obvious that it makes sense to deploy capital that way. And often when we do that, we're using a basket of stocks to disperse our risk.
Yes. And that would let me maybe share this just on Ms. Lauren Templeton and talk about this memo. So Ms. Templeton, is this the memo that you're talking about?
It is. Yeah. It is.
Yeah, I found it. It was dated on the 5th of June, 2005. Okay, so guys, what we are going to do is we're going to take down this link and we will share it in the chat. Okay, so whoever is interested to read about the financial chaos in 2005, what actually happens. I think this is a very well written article, this memo, and we should read it. And it talks about how, the behavior of a person is so important. And to
stop right there, right where it says not yet. That is the most important paragraph in the whole memo. Not yet have I found any better method to prosper during the future financial chaos, which is likely to last many years, than to keep your net worth in shares of those corporations that have proven to have the widest profit margins and the most rapidly increasing profits. Earning power is likely to continue to be valuable, especially if diversified among nations.
Wow. This is what I can say. I mean, so profound. There's so much wisdom in it. Guys, I think we could actually follow, you can print this and put it inside your maybe holding screen. So always remind yourself that, what, not yet have I found any method to prosper during the future financial chaos. And Ms. Templeton just said, she probably thinks that the next financial crisis will be bigger than the one in the past, right? Just now you mentioned something like that.
Well, there's a lot more debt in the system. So because of that, I mean, governments can continue to print money, and I certainly assume they will. There are a lot of advocates of MMT. And, I think it works until it doesn't work, but there's so much debt in the system that the next financial crisis should be quite large. In my interview with Jim Rogers this past week, he said the same, and he said it might be the largest of my lifetime. And I certainly am on that side as well. So instead of being fearful of that, we can all anticipate it and say that, the largest financial crisis of our lifetime is most likely ahead of us. And how are we going to prepare mentally for that, to take advantage of it? Because that's also going to be the biggest opportunity in your life.
Yes. Trouble is opportunity. So with that, let me conclude today's session, because really there is so much that we can learn with Sir John Templeton, the Templeton way of investing. And regardless how many times that we listen to Miss Lauren Templeton, we can always get nuggets or even reminders to remind ourselves that, please, the stock market every day moves up and down. Today, it is at 36,000 in terms of the Dow Jones. We thought there's a correction, but I just looked back 5 years ago. Just 5 years ago, it was just barely 20,000 points, just in less than 5 years. And with the COVID in between, it actually increases, almost double, right? Mm-hmm. So invest in good assets, invest in good businesses. And most importantly, always remember this: trouble is opportunity. So thank you very much, Miss Lauren Templeton, for joining us today, because we have benefited so much. I hope we can hear more from you. And of course, you have given us the contact. So guys, remember, if you want to have the newsletters, you can always subscribe to the newsletters, and you can learn more on what is the Templeton's way and the latest information and news of investing. Thank you very much, Miss Lauren Templeton.
Thank you, Pauline, and thank you, V College. I've enjoyed today.